Hey everyone. Thanks for joining me today. We're going to dive into a deep analysis of a company you might not know much about but that is absolutely critical to the healthcare system. McKesson Corporation. So, what is McKesson? Think of them as the master logistics operator of the pharmaceutical world. Their main job is to be the essential middleman. They stand between the massive drug manufacturers and every place you get care: the hospitals, the clinics, your local pharmacy. They have a few revenue buckets, but one is massive. Pharmaceutical distribution. This is their biggest revenue source. They buy medicine in bulk from manufacturers and then their logistics network distributes it to places like retail pharmacies, hospitals, and health systems. They make money on a small distribution margin and service fees. They also distribute medical surgical supplies, think gloves, syringes, and surgical instruments, to doctors' offices, clinics, and surgery centers. And critically, they are focusing on specialty pharmaceuticals. These are the complex, high-cost drugs for things like oncology and biotech therapies that require specialized handling and patient support. Finally, they offer technology and data services, software to help pharmacies and providers with inventory management, billing, and patient safety. They still earn some revenue from Canada and Europe, but they are increasingly focused on the US market. This is the most important part of the business, its competitive advantage, or its moat. Why don't hospitals just buy direct? It comes down to a few key areas. Scale is king. McKesson aggregates demand across thousands of providers. This massive volume allows them to negotiate better drug pricing than any hospital could get on its own. Their gross profit margin is actually tiny, just 3% to 4%, but that scale makes it impossible for new rivals to compete. The logistics nightmare. Building a nationwide network of distribution centers for same-day/next-day delivery and advanced cold chain capabilities for biologics is incredibly complex. It's hard for hospitals or pharmacies to build and manage these infrastructure themselves just to save that 3 to 4%. Regulatory compliance. They manage strict DEA/FDA rules for controlled substances, protecting customers from legal and financial risk. Customer lock-in. McKesson's IT systems integrate directly into the hospitals' and pharmacies' inventory and billing systems. That creates extremely high switching costs. If a customer tries to leave, they have to redo their core operations. Customers also rely on McKesson for mission-critical supply and have decades-long contracts. This business is dominated by three main players, an oligopoly. McKesson, Cencora, and Cardinal Health control nearly 90% of the U.S. drug distribution market. McKesson holds about 33% market share. I view them as the safe giant. They're known for heavy stock buybacks, very steady cash flow, and they are the biggest in prescription and specialty drugs. Cencora is right behind at 30%. This is often seen as the growth stock of the group because they are so closely tied to the expansion of specialty biotech medicines. Cardinal Health holds around 25% and, while large, are generally considered the weakest of the three in terms of drug distribution, though they have a huge medical supplies business. Let's move on to the company's long-term trends, where we see clear evidence of its durable competitive advantage. First, the growth engine is working well. Revenue has been growing consistently over the years, which is exactly what you want to see from a market leader. Next, looking at profitability, we see stable margins for EBIT, net income, and free cash flow. This stability proves they have a durable moat. Now, I will point out that gross margins are trending down slightly, but the management is actively addressing this. They're aiming to focus heavily on higher margin businesses, such as the distribution of cancer medicines, to boost that growth and profitability going forward. Finally, and perhaps most impressive, is the return on invested capital, ROIC. This metric has consistently grown over the years. A high and growing ROIC means McKesson is becoming more and more efficient at turning every dollar they invest back into profit. This is a telltale sign of a truly great business. The business is fantastic, but here's where we hit a snag: the price. I used a simple discounted cash flow model, assuming pretty strong growth, 10% for the first 5 years and 5% after, and my model spit out an estimated fair value of $548 per share. The current share price is around $760. That means, right now, the stock appears overvalued with no margin of safety. I have learned over the years that DCF model is never an exact science and the numbers should only be taken as an estimate. Tweak the growth by 1% or 2% or tweak terminal value assumptions slightly, and you'll get a very different number. Next, we move on to the price multiple analysis, which helps cross-check our view on valuation. The current EV to sales multiple of 0.27 is what translates directly to the stock's current price of around $760. Now, if we look at what I consider a mid or reasonable entry point, that would be an EV to sales multiple of 0.2. At that level, the price would be much closer to $546 per share. A low multiple, a great bargain, would be around 0.14, which would put the price down at $364 per share. I'm not sure we'll ever reach that low, but the market has certainly surprised me before. So, to wrap up our analysis of McKesson, we've got a classic good company bad price situation. On the positive side, the business is good. However, the price is a bit high. Therefore, my action plan is to wait for a better entry point, ideally targeting $546 per share or lower. The key catalyst to watch is the management's success in continuing to expand into the higher margin distribution of cancer medication. And that is all I have for you this week. What do you think about McKesson's future and its valuation? Let me know in the comments below. Don't forget to like and subscribe for more content like this. Thanks for watching, and I'll see you in the next video. Bye.